21. Right. Okay. So what I'll do at the beginning is I'll try to quickly remind you of what we did in the previous session, and then we'll continue from that point onwards. So these were the two questions that we asked in the previous session. So our two main objectives were to create an optimal risky portfolio. And how do we create an optimal risky portfolio? So this is something that we covered in the last session. So we create an optimal risky portfolio by maximizing the Sharpe ratio, right? So we can create a number of portfolios by simply changing the weights of the assets in the portfolio. But which of those portfolios should we go for? We should go for an optimal portfolio. And what is an optimal portfolio? A portfolio that lies on the efficient frontier. So an optimal portfolio is one that gives you the maximum return for a given level of risk. And how do we calculate that optimal portfolio? By maximizing the Sharpe ratio. So that is what we did in the previous session. So the next thing that we have to do is to create an optimal complete portfolio. So how can we create an optimal complete portfolio? By maximizing the investor's utility. Okay, so this is what we are going to do today. So, okay. So we worked through a number of examples in the previous session, so we'll continue with the same example. Okay. So this was a slide where we stopped in the previous session. Okay, so we had two, the example that we were working with, we had two stocks, stock D and stock E, right? Okay, and we wanted to create an optimal portfolio. Okay, so the optimal portfolio that we identified using this example was this point P, right? And you can see the efficient frontier here, right? So we can create any portfolio using combining these stocks C and E, right? So the portfolio could be any point within this efficient frontier. So any point on this efficient frontier will be the optimal portfolio. So your objective would be to create a portfolio that is as close to this efficient frontier as possible. Ideally, it should be on the efficient frontier. So using the numbers, using our example, we solved for the weights. So, so based on the example, if we put 40%, if we invest 40% in stock D and 60% in stock E, that will give us the optimal portfolio, which will have the highest Sharpe ratio. And that's been shown here on the slide at point P, right? So if you put 40% in stock D and 60% in stock E, the resulting portfolio will give you a return of 11%, and the risk of this portfolio is around 14.2%. Okay, good. So that's the scenario in the absence of a risk-free asset. So on the slide, you can see there are different points, right? For example, you have a portfolio, point D, point P, point E, and you could also add a number of other portfolios as well, right? So you can add, a number of other portfolios, but all of these would be, under this efficient frontier, right? Or you could have a portfolio here, a portfolio here, a portfolio here would be, more likely the minimum variance portfolio that has the least risk. Okay, so you can see you can create a number of portfolios. But the optimal portfolio, given these two assets, stock D and E, is represented by point P. So point P, so this portfolio will give you a return of 11%, and it has a variance of 14.2%. Right, so now what we're going to do next is we're going to introduce a risk-free asset. Okay, so up till now, what do we have? We were creating a portfolio that will give us the maximum return for a given level of risk, but we were only using the risky assets to create that portfolio. But what if we have a risk-free asset? If we have a risk-free asset, then we have another option to allocate some of our funds to the risk-free asset and some of the funds to the risky portfolio, right? Okay. In the absence of a risk-free asset, we can create we can create a lot of portfolios, but all of those portfolios will be, either these red dots or these will be, the points on the efficient frontier. So you can't go beyond this, right? You can't go beyond this efficient frontier. But if you have a risk-free asset as well, well, let's say we have a risk-free asset, and in this slide, if we say that risk-free asset gives you a return of 5%, given that it's risk-free, so its standard deviation will be 0, right? So if we have a risk-free asset now and an optimal portfolio represented by point P, so you can choose to invest, either in the risky portfolio P, or you can choose to invest in the risk-free asset, or you can create a combination, a portfolio of risk-free asset and the risky asset, right? So in this case, you can see if you combine this risk-free asset with this risky portfolio, you can draw a line and you can create portfolios on this blue line as well. If you put all of your money in the risk-free asset, right? If you put all of your money in the risk-free asset, what will you get? You'll be at this point, right? Your return will be 5% and your risk is 0. Okay? And if you put all of your money in the optimal risky portfolio, what will you have? You will have this point P, right? Where the expected return is 11% and the risk of this portfolio is 14.2%. Okay? But you can create, a combination of these two as well. You don't really have to put all of your money in the risky portfolio, or you don't have to put all of it in the risk-free asset. So you can put some of the money in the risk-free asset or some of the money in the risky asset. So let's say if you choose to put 50% in the risk-free asset and 50% in the risky portfolio, you will be somewhere in the middle of this line, right? Okay. And in this case, your expected return will be around this much, right? And the risk of this portfolio will be around this much, right? Okay, so now you can see by introducing a risk-free asset, you can create portfolios outside this efficient frontier as well. Okay, so you can have a portfolio, which can potentially lie on this blue line, right? Okay, as I said, if you put all of your money in the risky portfolio, you will get to point P, right? If you put 100% investment in the risky portfolio, you will hold the portfolio represented by point P. But you can see this line extends beyond P, right? So it goes further up. How can you go up? How can you go above this point P? So you can hold the portfolio at any point on this blue line, right? As I said, right? So from at the bottom of it, where you put 100% in the risk-free asset, right? So from this point, if you start increasing weight of the risky, start investing in the risky portfolio and start increasing the weight of the risky portfolio, you will keep on going above this line until you reach the point P where all of your investment is in the risky portfolio. How can you go above this line? Yeah. Very good. So you can create a portfolio that's above point P by borrowing, right? So now if you want to invest more than 100%, what are you going to do? You're going to borrow at the risk-free rate and use that additional borrowing to invest in the risky portfolio as well. So as a result, you can create portfolios above this point P as well. Okay, good. Right. Okay. So if I ask you this question, so now you have these options, right? You can select any portfolio, uh, either on the blue line or on the efficient frontier or any of these red dots within the efficient frontier, right? So which portfolio would you go for? Which portfolio would you prefer? There is not right or wrong answer. All I want from you is, what do you think? You can choose any portfolio if you're liking, right? For simplicity, I would say, okay, so those who would hold the risk-free asset only. Can you raise your hand? Those of you who would only hold the risk-free asset, and if they hold only the risk-free asset, they will, they're kind of guaranteed a return of 5%, and there's no risk, right? Okay, so those who will hold risk-free assets. Two people. Good. Okay, so those who would hold 50% of the risk-free asset and 50% of the risky portfolio. Let's say this point, right? Let's say this portfolio. Okay, good. Right, like this, right? Raise your hand like this. Good, very good. So you'll have some 50% in the risk-free asset and 50% in the risky portfolio. So those who would hold the portfolio P, which is the risky portfolio, anyone who would hold the risky portfolio alone? Yeah. Four people. Okay, good. Anyone would want to hold a portfolio which is above point P on the blue line? Good, good, very good. Okay. So you can see, different people will create different portfolios. All of these are efficient portfolios, right? All of these, as long as these lie on this blue line, all of these are efficient portfolios, right? Because they give you the maximum return for a given level of risk. So why do people have different? Why have you opted for different portfolios? Because you have different risk preferences. Okay, so when you have to create an optimal portfolio for yourself, you would need to take into account your risk preferences. So those who are extremely risk averse, they will go for the risk-free asset. They'll put all of their money in the risk-free asset. And those who are like really, really risk loving, what are they going to do? They are going to borrow at the risk-free rate and invest in the risky portfolio, right? So they'll create portfolios which are even above point P. Okay, so when it comes to individual investors, so we not only have to do whatever we have done so far, but we also need to take into account individual risk preferences. Okay, so to do that, we'll look at investors' utility. So here's the formula to calculate investors' utility. What is utility? Right? What do we mean by utility? Anyone? Yeah. It's like a benefit, right? How much benefit you're going to drive from certain activity or certain thing, right? Or in this case, investment, right? So we can create a utility score using the following formula. So what do we have? Expected return, which is the benefit, right? Why do you invest? In the hopes to earn some expected return. So expected return is the benefit, but there's a cost to this investment, right? Okay, and what is that? The risk. Okay, and so this, in the second term, you have risk. And then we have an additional term, A, right? So we know risk is measured by variance or standard deviation. And this additional term A represents individual investors' risk preference. Okay, so here we call it aversion to aversion to risk, right? Okay, so looking at this equation, what can we learn? The utility will be greater when expected returns are higher, and utility will be lower when risk is higher or when individuals' aversion to risk is greater. Okay, so this is what I just said is written here on this slide, right? Okay, so um, so given a specific level of risk, the utility scores decline with higher risk aversion, that is higher A, and the utility scores increase with lower risk aversion when A starts to decrease, and A will be lower for risk-loving individuals, and it will be higher for risk-averse investors. And then we have a term called risk neutral, right? So who are these risk neutral investors? So risk neutral investors are ones who don't actually care about risk. The only thing they care about is expected return. So risk neutral investors will have a value of A equal to 0, and they will have a utility score equal to the rate of return because they only care about the return irrespective of the risk involved. Right. So using this utility concept, we can draw indifference curves. And I'm sure you must have heard and learned about these indifference curves in your um, O levels and A levels, right? And even in some of the modules here. So what is an indifference curve? An indifference curve is one on which all portfolios will have the same benefit, will have the same utility, right? So you can choose any point on this indifference curve as long as the point is on this indifference curve, you will have the same utility. So you can choose any point on this indifference curve. So for example, here you can choose either point P or point Q, right? So both lie on this indifference curve, which means investor will be indifferent between portfolio P and portfolio Q because both portfolios give the same level of utility to the investor, right? How do they provide the same level of utility? So portfolio P has a lower risk and offers a lower return. Portfolio Q is slightly more risky but offers a higher return as well. And if using the formula here, if you try to calculate the utility, both points will give you the same utility, right? And we know they will give you the same utility because they lie on this utility curve. Oh, sorry, in the indifference curve. Right, so here is an example for you, right? So we can see, here we have different portfolios with different expected returns and different risk, right? So column 1, expected returns, column 2, the standard deviations or the riskiness of those portfolios, right? So you can see, expected returns are increasing, and so is the standard deviation as we go from top to bottom. And using the utility equation, if we calculate the utility using the formula expected return minus 1 over 2 times a measure of uh, risk aversion represented by A and the riskiness of the investment. So in this case, what do you see? So if you calculate the utility for all of these is the same, right? 0.02. So although the portfolios are different, their returns are different, their risks are different, but in terms of utility, they provide you the same utility, right? Which means as an investor, you should be indifferent between any of these portfolios because they provide you the same benefit. They give you the same utility, right? So here, to solve this problem, I assumed a risk aversion A equal to 4. Okay, good. Right. Okay. So if I change this A, what do you think will happen to utility? Utility will also change, right? So that leads to this next question. How will the indifference curve of a risk-averse investor compare to the indifference curve drawn in the previous slides, right? Okay. So if this is the indifference curve of, let's say, a risk-averse investor, how would this compare with that of, let's say, a risk-loving individual? Okay. So the more risk-averse you are, the steeper will be the indifference curve. Okay, the more risk averse you are, the steeper will be the slope of this indifference curve. Why? If you look at this blue line, right? So this is for a risk averse individual. So what does it show? The slope is very steep, right? But even for a small increase in risk, you expect a greater reward, right? A greater increase in expected return, right? So that's the characteristic of a risk averse and risk averse individual who doesn't like to take risk. But for risk loving, or those who have a low risk aversion, their slope, the slope looks more like the black line, right? Okay, good. Okay. So now let's create this optimal complete portfolio. In order to do that, the question that we have to answer is how much of our investment is going to go into the risky asset and how much of it we are going to allocate in the risk-free asset, right? And the answer to this, as I already told you from the broader concept, is based on individuals' risk preferences, right? So those of you who like to take risk, they would hold more of the risky portfolio. And those who do not like to take risk, they will hold more of the risk-free asset. So in order to create this optimal complete portfolio, individual differences in risk aversions lead to different capital allocations. More risk investors will choose to hold less of the risky asset and more of the risk-free asset. So investors can determine how much they're going to invest in the risky asset, right? Using the following formula, right? So because the choice here is the risky portfolio or the risk-free asset. So investors can determine Y star, the amount of money that they're going to invest in the risky portfolio. And if they're going to invest Y star in the risky portfolio, then what are they going to invest in the risk-free asset? 1 minus Y star, right? Whatever is left. Okay. Can you remind me how much did we, when we were creating the optimal risky portfolio, we had two stocks, D and E, right? How much did we invest in D? How much of our wealth did we invest in D? It's on the previous slides. We invest 40% in D and 60% in E to create the optimal portfolio P, right? Okay. So once we have that optimal portfolio, now we introduce a risk-free asset. Now we have to decide how much of that investment we are going to invest in the risky portfolio and how much of it we are going to invest in the risk-free asset, right? So Y star here will give us the amount of investment that we are going to make in the risk-free, sorry, in the risky portfolio. And you can see this looks like more like a Sharpe ratio, right? This looks, very similar to a Sharpe ratio, except that it has this additional term A, which takes into account individual risk preference, right? Or individual's aversion to risk. Right. So using the same example that we worked with earlier, if the risky portfolio gives you a return of 15% and the risk of this portfolio is 22%, we can calculate, and the other asset that we have is a risk-free asset. And if risk-free asset gives you a return of 7%, given it's risk-free, so the risk of this investment will be zero. So we can calculate how much we are going to invest in this risky portfolio and how much we are going to invest in the risk-free asset. So if we solve for the amount we are going to invest in the weight or percentage of our investment we are going to invest in the risky portfolio, it turns out to be 0.41%. It's not percent, 0.41 or 41%, right? But this is with the assumption when the risk aversion is equal to 4, right? So if we have an individual that has a risk aversion equal to 4, he or she will allocate 41% in the risky portfolio and the remaining 59% in the risk-free asset, right? Okay. So what if you change this risk aversion, right? If I change this risk aversion from 4 to 2, right? Then what is going to happen? Are we going to allocate more to the risky asset or less to the risky asset? Okay. So what I've done now, it's exactly the same thing, right? Exactly all the numbers are the same. The only thing that I've changed is the risk aversion. I changed that from 4 to 2 here. So which means if you are less risk averse, right, or more risk loving, right? If you have a lower aversion to risk, what are you going to do? You're going to invest more in the risky portfolio, right? Okay, so you can see if a risk averse individual will only invest 41% in the risky portfolio, but a person who is, who can tolerate more risk with a lower risk aversion will invest 82% in the risky portfolio and the remaining in the risk-free asset. Okay, so which one is correct? 41% or 82%? Anyone? Which one is better, 41% or 82%? Anyone? Yeah. Yeah, it doesn't matter, right? Because it depends upon individual risk preference. Very good. Okay. Good. So if you look at, so these are the two individuals that we were talking about, right? A risk averse will invest, 41% in the risky portfolio. As a result, the expected return is 10.28% and the risk is 9.02%. A risk-loving individual will invest more in the risky portfolio. That's represented by this red line, right? Okay, so the expected return is higher, but the risk is also higher, and it's simply, you can see both of these lie on this same blue line, right? So the first one is better or the second one is better, it makes no difference. Both are better because both are efficient portfolios, both lie on this blue line. It's simply a matter of risk preference. Risk averse individuals will be closer to the risk, will hold a portfolio which is closer to the risk-free rate, okay, because they invest more in the risk-free asset. And risk loving will hold a portfolio closer to point B because they invest more in the risky portfolio. Right. So the bottom line is that you have an efficient frontier, and then you can choose. You have to choose. Once you have created an optimal portfolio, you can you can create an optimal complete portfolio for yourself, taking into account your own risk preferences. So all you have to do is to draw an indifference curve, right? And the point, where your indifference curve touches this portfolio line, capital allocation line, right? That is the portfolio that you should hold, because that will give you the highest possible return, taking into account your individual risk preferences. So in this example, the example that we worked with, if we use the same numbers, right? So if we calculate the amount of investment we are going to make in the risky portfolio, that turns, and assuming a risk aversion equal to 4, we're going to invest 74.39% in the risky portfolio and the remaining amount in the risk-free asset. So here you can see, we're investing a lot more in the risky portfolio. As a result, the point C, which is our complete portfolio, lies closer to the point P, right? Because we're investing 74.39% in the risky portfolio, a lot more, okay? Given a risk aversion level of A equal to 4. Okay, good. Right. Okay. So, what are we going to do now? So previously we created a risky portfolio consisting of stock D and E, invested 40% in D, 60% in E, right? That's all of our investment, right? Okay. But now we introduced a risk-free asset, so we can choose, a combination of risk-free asset and this risky portfolio. And given our risk preference, right, or risk aversion, we have decided to allocate 74.39% in the risky portfolio and the remaining to the risk-free asset. As a result, we are going to hold this portfolio C, which lies on this blue line. Okay, so how are we going to allocate our funds now? Okay, so 74.39% goes to the risky portfolio, which means 1 minus 74.39 would go to the risk-free asset. Okay, but the 74.39%, which we are going to allocate to the risky portfolio, that consists of two stocks, D and E. So 40% of that 74.39 would go to stock D, and the 60% of that would go to stock E. And that's how we create this complete portfolio, where we maximize the utility for an individual who has a risk aversion A equal to 4. Okay, as you change A, your allocations would change as well, right? Because now you are taking into account individual risk preferences as well. So the Sharpe ratio, if you calculate the Sharpe ratio for this, that turns out to be 0.42, which is the optimal, based on what we calculated earlier as well. So to summarize, right? So what do we need to do to create this optimal portfolio? Identify the right allocation of capital in the risky assets. In our example, stock D and E, right? We calculated it to be 60% in D, 40% in D and 60% in E. So that's the first step, right? Create an optimal risky portfolio. Once you have created an optimal risky portfolio, in the next step, you have to determine the right allocation. You introduce the risk-free asset and then determine the right amount to allocate in the risk-free asset and the remaining to the risky portfolio, taking into account the risk aversion of an individual investor. So the risky portfolio is the one that has the highest Sharpe ratio, and as long as the portfolio that you hold lies on the blue line, which is a combination of risk-free asset and the risky portfolio, you will always hold the optimal portfolio. Good, so that's how we allocate uh, our investment funds and create optimal portfolios. Good. Do you guys have any questions relating to this before we move on to the next part of this session? Yeah. Good. Very, very good question. So how do we know what is the right risk aversion, right? A equal, we know what number, right? So as I said, it's based on individual preferences, right? If you are really risk averse, you would use a higher number. If you are risk loving, you would use a lower number. So you can scale them up. No, no. Yeah, it's based on preferences, individual risk preferences. No. So no. There is no kind of maximum or minimum here, right? It's simply a matter of preference. Unless you are able to scale those preferences in an ordinal fashion, right? Okay. So for example, the risk preferences of people in this class might be very different from risk preferences of, let's say, who are pensioners, right? Okay. So if you want to create a scale of it, all you have to do is to collect all that information and then create a standard scale for it, right? Okay. All right. Anything else? No. Good. All right. Good. Okay. Good. So now you have learned, how to create, uh, you know, so you're in final year of your uh, degree, and you have, and by now you have learned a lot of finance, right? A lot of economics, finance, and accounting, right? Okay, what should I say here? What does it say? Um, says, okay, would you like to turn presenter view off? Okay, let's turn it off. Right. Okay, good. Um, right. Um, let's check how much time do we have. Okay. Right. So what are we going to do now is we are going to, so this is for like session 5 and session 6. So I'll, we'll start talking about efficient markets, and then we'll continue with this session in the next week. Okay. So the slides are for this part of this session and the next session. Right. Okay. Good. So okay, let's start with this. So as I was saying, by now you have learned a lot of accounting, finance, economics, right? And we recently covered how to create optimal portfolios, right? And how you can create complete portfolios taking into account your individual risk preferences, right? Okay. So why do we do all this? Why do you need to learn all this, right? Why are you in this class? Why are you learning all this? Anybody? Okay. Why are you interested in creating optimal portfolios? Right? Why are you studying finance? Anybody? Nobody knows why they are here. Okay. I think the girl at the back knows. Is not listening to me. Again, why are you in this class? Come on, tell me. Sorry. Why are you studying finance? we're all waiting for you to give an answer, right? So much pressure, right? So much pressure. Okay? Say something. Sorry? To get a job in it, right? Okay? Very good. Well, why would you get a job, right? So if you come to me and you say, okay, I did financial markets, right? Theory and computations, right? And I learned about portfolios, right? I learned about portfolios. I know how to create optimal portfolios, right? So can I have a job, right? Why would I give you a job, right? Okay. Okay. So you need to keep in mind what is the objective, right? Why you're doing all this, right? You want to create optimal portfolios, right? Because you want to get the highest return for a given level of risk, right? Okay. So someone who doesn't know about finance or how to create optimal portfolios, they may be holding less than optimal portfolios, right? Okay, if you don't know, then you might be holding a portfolio that gives you a lower return for the given level of risk. But if you know, right, if you see a portfolio that offers a lower return, right, essentially that portfolio is mispriced. That's what it means, right? Okay. It, an optimal portfolio should lie on the efficient frontier. If you see a portfolio that's not on the efficient portfolio, or sorry, on that's not on the efficient frontier, or it's not close to the efficient frontier, then you can tell that there must be some sort of mispricing. And if you can identify mispricing, that's how you make money, right? So what do? You buy stocks that that are undervalued, right? You invest in stocks or assets that are undervalued, and that's how you make money because you're buying an undervalued asset, okay? And you sell stocks or assets that are overvalued, and that's how you make money, right? Buy undervalued assets and sell overvalued assets. How realistic? Okay. Good question, right? Absolutely realistic, right? I don't know how to answer that. What's the better word for it? It is, so the good thing about finance and accounting is whatever we teach you, it's implemented in exactly the same fashion. Right? There's no difference, right? When you go into industry, right, they won't teach you to create a different portfolio or portfolio in a different way. The optimal portfolio is always defined and calculated in the same way. Okay. But there, but you still see differences, right? And the differences in portfolios are mainly due to preferences of risk. Okay. So as long as you hold the portfolio on that blue line, of course, each point is different, right? Each point will give you a different risk and different return. But as long as it's on the line, it's an optimal portfolio. Which portfolio you'll end up holding depends upon your risk preferences. But if you hold a portfolio below the line, then it means that you have wasted your time and money. Okay? So you need to hold assets which are on the optimal, on the efficient frontier or close to the efficient frontier. If you see portfolios or assets that lie below it, right, that means there is mispricing. Okay? And mispricing allows you to make money, right? If you can identify, right? So the first thing is to be able to identify mispriced assets and then trade on it to make some money. Okay. So, so the first question is what drives share prices? So do you know the answer to this? How share prices move? How the price of stocks move or change? So what drives share prices? Anybody knows? Who said it? Good. So you read the slides, right? Information. Very good. Okay, good. So information drives stock prices. Okay. So we'll talk about efficient markets and its implications. And then we'll talk about rational markets. What are and what's the difference between efficient markets and rational markets? We'll talk about stock market anomalies. So the reason I asked you this earlier question is because you can see the practicality of it, right? So, we're learning about portfolios, optimal portfolios, you know, uh, taking into account risk preferences. What's the point if we can't make money out of it, right? If we can't use that information and see, whether that information is useful or not, right? Okay, and then lastly, we'll look at we'll look at some of the stock market anomalies, and lastly, we'll look at how can we test whether markets are efficient or not using event studies. Okay, so the next thing I want you to do is to go to this app or website. You can go to vvox.com. Let me just pause. Right. All right. Okay. Can you answer this question? Using knowledge acquired in different modules so far, right? Can you identify under or overvalued stocks? I'm using stocks, but it could be any asset, right? It could be any asset. So in your final year, using all the information, all the modules that you've taken, all the knowledge that you've acquired so far, using that information, are you able to identify mispriced assets, right? Okay, so let's see what you guys think. Very good. That's very impressive, right? Yeah, very, very impressive, right? So more than 80% of you believe that, all the knowledge that you have and the skills that you've acquired so far, you'll be able to identify mispriced assets, right? That's fantastic, right? But who are these 20, roughly like 19, 20% people? Who are these people? Right? 20% of you still don't feel confident, right? Okay, good. Um, right, okay. Okay, so the next question. Can you earn higher returns using your training at Nottingham University Business School? Can you earn higher returns? Okay, good. So let's see what you guys think on this one. Okay, good. Good. So yeah, that's certainly interesting, right? So it's now 60% of you think you can make money, but the 40%, you know, don't think that they can make money, right? Okay. Am I interpreting this correctly, right? Does does this mean the same thing, right? 61% of you think you can make money using your training at the university, right? And 39% still can't make money, right? Okay. But if you look at this, this is essentially the same question. I asked you the same question twice. So if I ask you the same question twice, your answer should be similar, right? Okay. I ask you the first question. Can you identify mispriced assets? And 80% of it believe that you can identify mispriced assets. Right? And as long as you can identify mispriced asset, you should be able to make money, right? Is that true? Right? So if I tell you that the stock's true value is 10 pounds and currently it's trading at 7 pounds, right? What are you going to do? You know that stock is mispriced, right? Its fair value is 10. Currently it's selling at 7. So what are you all going to do? You're going to buy it right now, right? At 7. Okay? And if everybody starts buying it, the demand for stock will go up. So eventually, the stock will rise to 10. Okay? And what have you done in the process? You've made a gain of 3 pounds, right? Okay? So that is my first question, right? Can you identify mispriced assets? And 80% of you agree that you can identify mispriced assets. And if you can identify mispriced assets, then you should be able to generate higher returns, right? So the expectation here was that 80%, at least 80% or close to 80% should have answered yes to this question, right? Okay. Good. Anyways, but 60% of 60% is still a good number, right? It's a really high number. That 61% of you believe that you can earn abnormal returns using all of the knowledge and training that you have acquired at this business school. Great, fantastic. Okay, but can you really earn higher returns, right? That is the in practice, right? So so this is your opinion, right? That's what we believe, right? That's what you think that you'll be able to do, right? So the first question that we had for this session: what drives stock prices? You already know the answer to this. Information drives stock prices. Okay. So let me just quickly give you some context, right? So again, before I show you anything else, let's just make sure, right? So what drives stock prices? Information, right? If, for example, all of a sudden you hear that there is a major breakthrough in cancer research, for example, right? And company A has found a cure for cancer, right? So that's new information, right? So what will happen to the stock price of company A? It should go up, right? Because there are lots of cancer patients, and company A would have patent rights on that medication or treatment, whatever it is, right? And you can see the company A is going to make a lot of sales and generate a lot of revenue, right? So as soon as this information comes out, and if the market is efficient, the stock price of the company A should adjust at this point in time, rather than when the actual sales take place. Okay. So that links with efficient markets, and I'll tell you, we'll define efficient markets as well. Okay. So let me show you this thing. Okay. Let's start with this. Let's see, what do we have here? Right. You guys all know this song, right? Is it just the sound or? Right. You all know this song, right? This is probably one of the most famous songs, right? You know this, right? Anybody who doesn't know this song? Anyone in this class who doesn't know about this song? Come on, tell me. So it means everybody knows, right? Okay, good. Okay, right. Okay, so this talk has something to do. This song has something to do with this company called VI Corp. So does information always drive share prices? So here we have this case of DI Corporation. So what is this? What do we know about this corporation, this company? It's a small Korean semiconductor equipment company that's founded in 1955 and listed on the Korean Stock Exchange in 1996. Okay, so if you look at its market capitalization in June 2012, it's around 38 million. Right, so you can see it's not a big company, right? The size of this company in 2012 is 38 million. If you look at its sales and income or profit, right? So sales around 88 million, net sales 88 million in by end of 2012. And if you look at pre-tax income and compare it to the previous years, in the previous year, the company had a loss of 12.7 million. And by end of 2012, it had a profit of just like 1.9 million, right? So that's the context of this company, right? A small Korean company that deals or trades in semiconductors. Okay. so, so, so the questions that I have to ask you are the following. So when the song that I just showed you came out, the share price of this company jumped by 800%. So why did DI Corp's share price jump almost 800% in 3 months when there is no material new information? Although the share price adjusted, they did fall down. They did fall down. Okay, but why is there such a sharp increase, like 800%, right? 800% is like a lot of money, right? Okay. So the next question is what might this have to do with the widely successful Gangnam Style K-pop single by Psy, the South Korean rapper, right? So the DI Corp increased by 800% as soon as the song came out, right? Can you see any link between the two? What does the song have to do with the company, right? And the company is, if it's being like a music company, then you can say, okay, there is some association, but it's a semiconductor manufacturer, right? Okay. Can you see any link between the company and the song? There is no link, right? There's no information relevant to the company. Okay. The only link between the song and the company was that uh, the Psy's father, Mr. Park, was the chairman of this company, DI Corp. Okay, so that's the only link between the company and the song. The singer's father is the chairman of the company, right? Okay. So the question is this rational? So Sai sang a song that has nothing to do with semiconductor manufacturing or trading, then why did Sai's father's company's share price went up by 800%? Okay, what 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 did we say earlier? What drives prices? Information. Okay, so I gave you an example. If a pharmaceutical company finds a cure for a drug, a cure for a disease, right? That's new information, relevant information. That will drive sales and profits. That's relevant information. That should affect the price. But how can a song affect the share price of a semiconductor manufacturer? Okay, so is this rational? What do you guys think? Is this rational behavior? Is the change in stock price rational? Yes or no? The 800% increase in share price of DI Corp, is this rational? It's not a difficult question, right? Okay, that doesn't seem rational, right? Why doesn't it seem rational? Because there is no link between the song and the company, right? Okay, good. So if you if you see some sort of irrational behavior, then what can you do, right? What should you do? Okay. Okay. So this is what I reiterated multiple times in this session already. So the central tenet in finance and market-based accounting is that only information should drive stock prices. The only information, and here it says information, right? But what we essentially mean relevant incremental information, right? But this case shows how non-informative information, that is sentiment, can also drive prices, right? So Thais, whose real name is Jay Sang Park, if I'm pronouncing it correctly, right? So his Gangnam Style video got more than 1.8 billion hits on YouTube from July 15, 2012 to the end of 2013. So 1.8 billion hits on YouTube. It was number one on pop music charts in more than 30 countries, including the US and the United Kingdom. So, so as the song became more popular, Psy's family relationship became public knowledge through news media in several languages. Market cap for this company went up from 38 million to 334 million. Okay, and by the end of 2012, it was still 130% above when the Gangnam Style was released. Okay, so if you were holding this company, right? So in a space of like 3 months or so, you would have translated that 38 million into 334 million in 3 months. Okay, right. So what really drives stock prices then, right? What does this case show you? That information alone may not always drive stock prices. So stock prices in an ideal world should only be driven by relevant incremental information, but at times, they respond to stock prices respond to other information, other events as well, which are not actually value relevant, but they do at times, right? So here, what do we see? So the blue bars show the volume of returns to Korean stock exchange volume uh, in basis points, and then we have the red line that shows the cumulative abnormal return. So if you look at these if you look at this chart, so what do you see? Before like 2012, there's absolutely nothing, right? Right? The red line is like close to zero, right? And then all of a sudden, the returns go up, you know, and you can see they do go down later on, but it's still, 130% above than the original level. Okay. So what we have here is, on the slide you can see, different um, events. I call them events, but these are essentially, news about the song as um, different media outlets in different countries cover the song. And you can see there is some sort of correlation between the media coverage of the song and the returns of this company. Okay, so for example, here on 27th of September 2012, English news in Korea and China talks about the song, right? Okay. And then we have 30th September, Spanish news in Chile, Portuguese news in Brazil. They also talk about the song, and as the song becomes more popular, it's covered in more languages. It's covered in different languages, different countries, right? The relationship between the song and the relationship between the singer and the company becomes public knowledge. More people get to know. I mean, before the song, people hardly knew that there is a company called DI Corp, right? But as the song became more popular, more people got to know about this connection. So essentially, you can see more people became aware of this company, that there is a company called DI Corp, right? Okay. And what did they do? What did they do? If you know, if you like the song, right? What did you do then? You you started buying the company stock as well, right? Pushed up the demand. So as more people came to know about the connection, more people, uh, uh, tried to buy the shares of the company, pushing up the price. As a result, you can see stock price jumped by 800%. And you can see, the different at points, different points, different countries are different countries and are covering the news agencies in different countries are talking about the song and different languages. So there's this channel. You can identify the channel now, and that's through retail investors. Okay. Okay. So DI Corp share price primarily driven by individual domestic investors as flash mobs and parodies. Once the copyrights were waived off, so these flash mobs and parodies were uploaded from overseas countries as well. So which allowed the song to become more popular, become much more famous and known in other countries as well. So this is what they use as a measure of stock attention. The more people know about it, the popularity of the song can be seen as a proxy of the attention given to that stock, right? So in the absence of the song, hardly anybody would have paid any attention to this one. But with this song, more people came to know about the company and the stock, and then they started investing in it. The closer geographically to the location of the flash mob and parody videos, the more individual investors became buyer of DI Corp, right? So the closer you are, where the flash mobs are uh, generated or parody videos are uploaded, the more people in that particular country started investing in the company. So essentially, what do you see? How can we explain this irrational behavior? An increase of 800% in the share price of DI Corp. So if you look at this is essentially an individual investor story. It's not about cash flows, right? It's not about the risk of the stock, right? What is it about then? It's about you know individual investors getting to know about the company, liking the song, assuming that the company would also be good, and trading on the company. So if you look at the institutional investors' ownership in this company, that remains unchanged around 10%. So institutional investors, what do you conclude from this? Institutional investors are unaffected by this news, unaffected by the popularity of the song. So they maintain their 10% stake in the company. So if they are maintaining their investment in the company, then what is driving the prices? It must be the individual retail investors. So most trading in the stock was by Korean retail investors, and it's these Korean small Korean retail investors that drove up the prices. So what does this case tell us? Does real information always drive stock prices? This case now tells us the answer is no, right? Okay. So so when we go in the market, we need to take into account other factors as well. So investor recognition. So there are a number of possible explanations of why this company did really well in that period, right? So what I've listed here is the possible explanations, right, for the 800% increase in returns. So we could have investor recognition or awareness hypothesis, which as I explained, more people getting to know about the company and investing in the company, right? So you can use it as a measure of investor attention, and so and if attention investor drives investment decisions, then what do we learn about markets being efficient? It could be investor sentiment and psychology, right? So psychology can also play a part in how individual investors make their decisions, right? So if you like the song, for example, if you like the song, then that's fine. It's a good song, right? If you like it, but does it really mean that you should invest in the company of that in the related company as well, right? The two are completely different things, right? So can people investments are driven by sentiments as well. Okay. Then it's the retail investors versus institutional investors kind of story. So who gets affected? Are these the individual investors who are being affected by this kind of sentiment, or is it the or or institutional investors are also affected by it, right? But the data suggests that it's only the retail investors. So you can see differences in the trading strategies and patterns of retail investors versus institutional investors. So another really important takeaway from this case is the important role of media in determining or setting market prices. So if, for example, if the song was not covered by other countries, in different languages, right? So if the song would not have been that popular in the first instance, but the media resulted in the propagation, right? Propagation of that information. And then international investors and a local bias. Another element to look at is the international investors, and the local bias. There's something that we might have already spoken about called home bias. So you typically invest in stocks that you're more familiar with, that are closer to you, right? And we call it home bias because it's closer to you, right? You're aware of it. Okay, good. So what do you think happens to DI Corp share prices when size follow-up song Gentleman was released globally on April 13, 2013? Okay, so what do we know? We have a stock, right? We have a stock here that was hugely influenced by the popularity of the Gangnam Style video, and we know, right? There is no connection between the song and the company, right? The two are completely different things. But let's say people invested because of the sentiment, because of the because they like the song, like the singer, like the company, right? and the stock price jumped up by 800%, and then the market realized there is no connection, so the market corrected, right? So once the market corrected, right? I mean, it corrected largely, but still not fully corrected because it's like 130% above the original value. So what do you guys think would have happened when the same singer sang another song like a year later? What do you think would have happened to the stock price? Do you think it should go up again? Yes, no? Yes? Why? Why should it go up? Yes, it went up last night, but that was irrational, right? It should not have gone up in the first instance as well. All right? Okay. So I think I'll let you think over this, and then we'll start with this in the next session with the same question. All right? Okay. I'll see you next week.